All right, what is up, tycoons? What's up, traders? Super excited for today's video. We're going to take a look at the financial sectors. There's a big banking crisis going on, as I'm sure you guys know, but things are actually getting much worse behind the scenes. So we're going to break down some of the charts, but before we do that, we're going to go into the New York Fed board member warns of commercial real estate risks, the risks around commercial real estate and how it's going to affect these banks. So make sure to smash that like button, subscribe to the channel if you guys are new. We do have some charts here that will go over the technical analysis. I'll break these down in a few, but I really want to go into why commercial real estate is going to be a problem or could be potentially a huge problem for the banks. And so if you look at this commercial real estate overview, all right, the big important part here is that around 60%, all right, is held by banks, guys, around 60% of it. So we're seeing these banks start to collapse and the commercial real estate sector is getting weak. And meanwhile, 60% of the banks, or about 60% of it, is actually owned by the banks. This is why you have New York Fed board members warning of commercial real estate risks. And if we dive in a little bit more, an executive who also serves on the board overseeing the New York Federal Reserve warned on Twitter of potentially systemic problems in the real estate finance market and called on the industry to work with authorities to avoid things getting out of hand, noting that there is $1.5 trillion in commercial real estate debt set to mature in the next 3 years. The bulk of this debt was financed when base interest rates were near zero. This debt needs to be refinanced in an environment where rates are higher, values are lower, and in a market with less liquidity. It is a perfect storm right now. Now, regional banks are a critical part of the commercial real estate ecosystem because their bankers invest a lot of time into forging relationships with real estate developers and managers. Before its collapse, Signature, which Signature Bank recently collapsed, if you guys don't know, Signature was one of the biggest commercial real estate lenders in the New York metropolitan area. In buying some of Signature's assets, New York Community Bank Corp picked up about $34 billion in customer deposits, down from the $88 billion that Signature had before the bank run, an indication of just how many customers fled the bank before regulators stepped in on March 12th to stem the bleeding. So if you didn't process that, initially Signature had $88 billion in deposits. Okay. But when New York Community Bank Corp picked up, picked up Signature's assets, they only got about 34 billion. So over $54 billion just kind of fled Signature that quick, which really kind of caused, some of the problems there in the whole collapse. So the first chart that I want to show you guys is XLF. This is the financial sector of the S&P 500. And this is the weekly chart. On the left we have here, and then we have the Wyckoff method on the right over here. So things are looking very similar currently at the current chart to our Wyckoff method. So I'll break down this for a second and really kind of explain it to you guys a little bit more. But what I want to do is show you guys a comparison of XLF to KRE. So XLF is going to be this chart here on the left, and KRE is this chart right here on the right. Now, KRE is the regional banking ETF. And a lot of these regional banks are the ones that are collapsing and have been seeing the big problems, such as Silicon Valley Bank. And you can see it had this head and shoulders pattern here forming. And we got a huge collapse after we broke the neckline. And of course, the news was the catalyst that really propelled this price action. But the main thing that I want to highlight here is that we had this gap down to fill, okay? And gaps, they tend to fill about 90% of the time historically. And what we can see here is that we had this gap on our weekly time frame all the way down to the $43 area on KRE. And you can see that once we collapsed and had this huge capitulation candles right here, you can see we actually came down and filled that gap. Now, XLF did see a significant drop in price from about $36 down to about $31. But the move was not as dramatic, where KRE was up here at the $64, $65 range and dropped all the way down to $43. So we've seen a much less dramatic move down in the financial sector, but we could potentially see more pain. If you pay attention, I think that there is a possibility that the XLF chart could turn into our KRE chart, where we come down and end up filling this gap down. Now, there's no guarantees, But this is something that I can see happening, especially if the banking crisis is just beginning. And that would put XLF in roughly the $26 to $25 region over the next few months or maybe even year. So that's something that I'm paying a lot of attention to right now. If you notice, we have this big trend line here of support. We tested once, we tested 3 or 4 times over here, a fifth time. The more times you test these trend lines, the weaker they get. And so what's a possible scenario, right? Also using technical analysis that could bring the XLF sector down to that $26 region. Well, that's where the Wyckoff method comes in. And if we take a look, right, we have spring right here, okay? Then we have spring as well. We got the breakdown and distribution as well, all right? Then we got our throwback, which is here what we recently got. And you can see after the throwback, there's a very large move to the downside. And it appears that that's what we're beginning. Now, this is the phase of correction, all right? And you can see the correction phase right in through here. Now, what's going to be really crazy is that if the Wyckoff method plays out, it would actually, after correction, take it down into the redistribution phase, which you can see here that there's actually another very small gap down to fill, down towards the $22 to $23 region. So if we end up seeing correction play out, all right, and we don't get back above the throwback levels, so this is how it would play out, right? Typically this is what you would look for. Now this pattern could be invalidated, okay, and just because something is lining up with the Wyckoff method doesn't mean that it has to play out. But this is definitely a scenario that you want to keep your eye on and just be prepared for, either mentally or to have some type of a hedge if you are investing in the banking sectors, because this is a scary scenario, guys. And this really is one of the scenarios that could take us down to fill these gaps down if we head into a redistribution phase and get this correction phase, which, as I mentioned, it looks like we recently just got the throwback, okay? And we're starting our move down. And you can see after this initial move down, you have some consolidation and a little move up, ultimately to head down towards the bottom of correction. And so we could start to see a little bit of rebound, sometime here soon. But ultimately, we're going to see if it'll bring us back down to test this trend line here also as well. And remember, if we break that trend line, then there's a really good chance that we could come back down and fill that gap on XLF. So that's basically it for today's video. Hopefully you enjoyed it. Smash that like button, subscribe to the channel if you guys are new. With that being said, I'm out.